First of all, I want to thank you all for coming. This is a very exciting tax legislation. It's probably the biggest tax legislation in 30 years. It contains the biggest tax benefit to small businesses in over 50 years. That would bring us back to 1968. Does anybody know what happened in 1968, tax legislation? That was the S election, the S corporations. The S corporations were very favorable. That happened in 1968. So this is big legislation that's taking place. I'm glad you're here. I think I like presenting to real estate agents because real estate agents are near money that's in motion. People are buying and selling houses. There's money in motion, and because there's money in motion, there's always tax consequences. So I think you can really help out yourselves today by learning, getting familiar with this, but more important, you can be a resource to your clients. Most of you all know who I am, know my story, including the part that I was born at a very young age. I don't know if Karen told you that. For those who don't know me, you might be thinking, I've seen this guy before. Isn't this the guy who eats our candy? I got a response to that. Possibly. And second, I am giving up candy for Lent. And then third, that's not what I do for a living. What I do for a living, I am a CPA. We provide tax-focused financial planning. We provide tax planning and tax preparations to business individuals. And we also do accounting services to HOAs and condominium associations. With that, we're going to get started. This, like I said before, this is the biggest tax legislation in 30 years. Some of it all came together within 50 days. So there's a lot of stuff that's going to have to be cleaned up one way or the other. The first thing that most people are interested in knowing is, so these are items we're going to cover, and there's going to be a lot of things that we're not going to cover. And this is just on the individual side. We're going to also tackle the business side. So we've got about an hour, so we're going to try to get everything we're done. So when we talk about this, there's going to be things we like, things we don't like. And this is kind of a political thing, so it can be. So what we're going to try to do is things that we're going to try to hold our emotions at the end. We'll go outside and we'll yell, cry, shout, and whatever, okay? So these things that we're going to be talking about, the first thing people want to look at is, well, what about the rates? So what I did is, if we had no legislation, this is what the rates would have been coming 2018. Okay? You'll see we have 7 rates, 7 brackets. We have 7 brackets going forward. Going forward, these are the new rates. And we still have 7 rates. You can see the rates have been lowered. What is kind of interesting, though, is when you look at individuals, head of household and married and filing separately, and the new rates, they hit the 30-plus rate a lot earlier. If we go back, you'll see that they hit the 30-plus rate at around $200,000. Now they're going to hit that rate at about $157,000. So it's going to be it's kind of an increased rate compared to what the law would have been. The other thing that's worth noting is the marriage penalty is eliminated at the lower rates, but it does come back into play at the higher rates. The head of household is advantageous in the early rates, but at the higher rates, at the higher income, the head of household benefit is de minimis. I think we all heard a lot about this, the standard deduction. The standard deduction is increasing by approximately $12,000. For head of household, you see numbers there as long as 12. $12,000 for other taxpayers. So what this is going to do is they think it's going to decrease the number of people who itemize. Nationally, on a national basis, 30% of people will itemize. What's kind of curious is that in the state of Maryland, that rate is much higher. 49% of Marylanders will itemize. Now what's going to happen is we think it's going to lower because the standard deduction is going to increase. So the charities are concerned about this. People who give and they're motivated by taxation, the charities are very concerned about this. One thing you can do if a person is taking RMDs, those are required minimum distributions, or they have parents that are looking at this and they're charitably inclined, they can take their IRA RMDs, and instead of taking the money, they can direct it to a charity, and the income does not hit their tax return. So you're not going to get deduction for the charity anyway. Why take the income if you're going to give it away? So it's another way of
So it lowers your.
right.
I have a question.
Yes.
Didn't we lose our personal exemption?
Right there, right on track.
Oh,
So the personal exemptions are gone. Now, throughout this thing, you'll see that things are suspended, or they're gone and they're coming back. Here you'll see that this is gone, but it's coming back.
Oh, it is.
Yeah, a lot of things a lot of things are suspended. They needed to get to a 1.5 trillion dollar deficit on this thing. This is how they came up with it. So this stuff reverts back to the old rules come 2026. Okay. So yeah, so but there's going to be a lot that happens between now and then. There's going to be 2 presidential elections between now and then. Lots going to happen. This is now. And I don't handicap what's going to happen because I rather bet on the Redskins than handicap what Congress is. All right? And I don't bet on the Redskins. The capital gains didn't change. But one thing I want to just remind you of, if you're in the what's now the 10 and 12% tax bracket, and you sell property that's subject to long-term capital gains, your rate is 0. In fact, we had a client call us and said, you know, I'm thinking about taking money from my IRA, or I'm thinking about selling some mutual funds and stock. What's better? And we said, well, you're in the 12% tax bracket. You're going to sell this thing, and you're going to pay nothing to the federal government for this gain. So when you're talking to people, remind them if they're in the lower tax bracket, they may not pay capital gains to the federal. To the state, it's a different thing. You will pay state income on that. Okay. The child tax credit. We lost the exemptions, but we got a child tax credit has been increased. It's increased to $2,000, and the phase out is much higher. It phases out at approximately $400,000 for married filing jointly. Single, it is $100,000, but it was $75,000 and $200,000 respectively.
Do you mind going over that child tax credit a little more?
Mm-hmm.
So are you saying that's when you're paying for people to babysit?
No,
Right?
no. That's your children. So that is you get a credit for.
Well, mine are
your
grown,
children.
so I don't know what's going on here.
Yeah. So that is. I'm glad you asked, and that is for your dependents. So that's your
Okay.
children. Up to.
So even though your personal exemption is gone, you get a credit for your kids.
What's that?
Even though your personal exemption is gone, you do get a credit for children.
If your children, say it again.
Even though your personal exemption is gone, you still get an exemption for children.
Well, this is a credit. This is better.
Oh, it's a
This is better.
credit.
This is reducing.
Oh,
the
yeah,
tax.
that's right. Credits are always better.
Always better.
Does that apply to adult child, like a disabled child, the federal
I'd have
government
to check that. There's a lot of.
classifies them as, adult children?
I'd have to double check that.
What's the cap? What do you say the cap is?
The phase is out 400,000 for marrying filing jointly, and then single is at 1,000. I think we all heard a lot about this around December 31st. Everybody was trying to pay their property taxes. What they're doing is limiting the state and what they call SALT, the state and local tax. And they're limiting it to $10,000. So you can do whatever you want to with it. You can use it for income taxes, you can use it for property taxes. What this is going to do though is probably motivate you to put the property taxes, if you can, on a different schedule. If you put it on slide it over your Schedule C, slide it to a Schedule E, you might be able to do that. Obviously, the high tax states are very upset about this, and I think when I was writing this, I learned that the high tax states, California, New Jersey, Connecticut, were in the process of suing the government over this.
So that
No, we
does
don't.
include property taxes and state taxes
And local income
combined.
taxes combined. So the combined, you can take 10,000.
Is that
So if
Okay.
you have a summer home and you have a,
multiple?
your own personal residence, and that's over 10,000, you don't,
Yeah,
you can only deduct 10,000.
you can only deduct 10,000.
So if you have multiple properties, then we can do 10,000, wasn't it at 25,000?
No, well, you could deduct property taxes all day long. So it was unlimited.
As long as you rent them out, then you can deduct it.
Well, even if it was a second home, you could deduct it as property taxes.
Oh,
Not more
okay.
than $10,000.
Is that per property? 10,000 per property?
No, total.
Yeah, that's where I'm getting confused.
It is total.
What was it before?
It was unlimited. You can take it. But you know, the other part of this too is, some of this was subject to alternative minimum tax. A lot of people didn't get it in the first place. If you really look at it, you probably weren't getting the deduction because you might have been alternative minimum tax. Because people can load up on taxes, pay a lot into taxes, and get preferential treatment, lower their tax burden. The government said, no, we're aware of this, and it's going to be a preferential treatment and add back. And if it, most people, if they were making 200,000, they were in alternative minimum tax. Sometimes we refer to it as alt-min-hel. But most people weren't deducting it weren't able to deduct it in the first place if they're itemizing. So now this is truly not going to let you to do it. Okay?
So this,
How can you put that on Schedule C?
How can you, home office deduction? If you can't, we'll talk about that. There's ways of doing it.
Just one other question. If you have multiple rental properties, can you not deduct the property taxes? on
No,
those?
no, that's a business.
Doesn't affect that.
That's a business. That's not affect
okay.
that. Oh, I'm sorry.
Okay.
yeah, I
I'm
was
sorry.
trying to get to that.
Thank you for the clarification. This is for personal. Only affects the Schedule A. If it's a business, it goes on Schedule E. There is nothing. Now, one thing that's going to have to be clarified on this is your Schedule C. Your Schedule C, it's a business. You pay taxes with that, and so now there's going to be an argument that, well, I pay state taxes based upon my income, which is from a business, therefore I should be deducted. That's going to be a fight. Okay? Okay, this is, do we have any mortgage bankers in? We don't want to hear them cry, but, so, and this is what, I think fired up your lobbyists. They kind of lost this, but they want a lot of different other things. This is the home mortgage deduction. They're limiting this. It used to be you could have a mortgage up to 1.1 million. It was 1 million for the mortgage, and they gave you another 100,000 for what they call home indebtedness equity. So what they really did is said, okay, the 100,000 we're bringing down to 750, and we're getting rid of that 100,000. So there is no more home equity indebtedness that you can deduct on your tax return. Okay. So you have the limitation, but when this first came out, people said, "Oh no, I have a second mortgage or home equity. I'm not going to be able to deduct it." That's not true. What they look at is the they look at the home equity indebtedness versus the purchase price indebtedness or acquisition indebtedness. So if you buy a home and you have to get a second to complete the transaction, that's a home equity loan technically, but you still will be able to deduct it because it is for the purchase of the house. Okay? Now, if you go out and you get a home equity loan and you add something to your house, that is acquisition indebtedness. It's still deductible. If I take a home equity loan and I to go on a vacation, that is personal. That would not be deductible.
If you have two homes and both of them together are under 750,000, are you okay? Or
You're
is it-
okay.
Okay.
Yeah, that's a good question. So what, I wrote this down here because I really want to work on this. This is one of the main things I want to talk about.
One question. Does it matter when the home equity loan is taken out, or just as for new home equity loans, even if you have one already in place, does it affect you?
It does affect you if you already have one in place. Okay. So what this means is, you kind of got to go back to your when you got the home equity loan and find out what you did with the money. It's called the tracing rules. What did I do with the money? Did I buy another rental? Did I use my home equity to buy a rental property? That would be deductible, but then it'd be deductible on Schedule E for a trade or business for a rental property. If I used it for starting a business, then it would go on that business return. But if I use it if I got this loan for personal reasons, bought a car, bought a car for business, that's a different story. But you look at the tracing rules, so you have to trace the money. And there's a lot to that. The last thing I want to talk to you about on this home mortgage thing, this is something that no one's really talking about. What happens if I refinance my loan?
That's what I was wondering.
Well, we're going to talk about that. So, if let's say I have a $800,000 loan, and under the existing laws, in the current laws, I'm grandfathered in. It's existing loan. I'm fine. Okay. But what happens? Where the trick is, what if when I go to refinance, I got a problem. I got a problem if I extend the loan. And I don't know how I was hoping the mortgage guys were here, but I'm not sure how you not extend the loan unless you just shorten the time period. So for instance, I have a mortgage and I've been paying on it and it's down to 23 years, okay? I go out, for whatever reason, I have to refinance. I go out and I refinance and it's now for 30 years. I'm now subject to this. So if I have an $800,000 loan, a portion of that is not going to be deductible. So be careful on refinances. If people come and say, hey, I'm refinancing, you might say, be very careful about that. The other thing I want to talk to you about, just going back to the tracing rules, you got to be kind of careful because you might say, well, I refinanced, I didn't take any money out. Well, maybe you did. You didn't realize it. So for instance, if I refinance $800,000 and a guy says, I can lower your payment to $200. I say, great, do it. He goes, well, it's going to cost you $15,000. And I say, oh, that's reasonable. Is that reasonable? I don't know. They said it's going to cost me $15,000 to refinance. I said, I really don't have the money. The guy says, no problem. We'll just roll it in. Well, that $15,000 I rolled in, that portion of the interest will not be deductible because that is not acquisition indebtedness. Okay? So, you think about this, you think, well, this is pretty technical. How's the government really going to track this? How are they going to enforce this? And we'll get to that. The medical expense deduction, very interesting. The House legislation, the House bill said that they were eliminating the medical deduction in its entirety. The House, the Senate came back and said, no, brothers, you got it wrong. We're going to limit, it was at 10%. I don't know if y'all knew that. They changed it over a couple of years from 7.5% to 10%. Senate said, no, you got it wrong, little brother. We're going to take it down to 7%. And we're going to roll it back to the beginning of this year. So this is one of the 3 items that are retroactive to 2017. So the medical deduction is 7.5% now, but in 2019 it changes. It goes back to where it was, at 10%,
10%.
and then 7.5% if you're over 65. So, if that means, I don't know if you want to plan for that, but there it is.
How do you do it?
Okay. Alimony deduction. This is one of the ways the government kind of deals with this, and deals with some of the issues. And this is one where they deal with it. And I want to talk about that. So the alimony deduction is gone, but it's gone on the agreements that are made after 2018. So we got a year to work things out. But 2018, after 2018, the alimony deduction is gone. What's kind of interesting about this is there was a 2010 government report that said there's I think a 43% gap between people who were claiming it a deduction and the people who were reporting it. Because if a person claims a deduction for alimony is paid, the recipient has to recognize that as income.
Right.
Well, there was a gap, and it was about somewhere in 40%, but it amounted to 2-point-some-odd billion. So you think, the government would say, you know what, we can, we always get these matching stuff from the government. The government says, this didn't match up. You owe us some money. Why didn't they do that here? Why didn't they just match it up and say, do that? I kind of think that they did it because they didn't want to get in the middle of it. because you start looking at legal documents and seeing who's right, and somebody was told that there was deductible, and the lawyer may not have been correct in assessing it. There's a lot of different rules. There's 7 different tests that alimony has to pass in order for it to be deductible. And I don't think the government wanted to get in the middle of that. And I just think that, so what they decided to do is, we're eliminating it.
I have a question.
Yeah.
So it's also saying that it's not included as income. So
That's
they-
correct, it's not included as income.
So that
Same
it's
time.
not gonna be taxed.
So it's not
So
taxed
they
on
don't have to
recipients.
pay tax on it.
Now, that is, but that is for agreements starting after a certain date. If you have an agreement in place, it is still in effect and will carry on. So they're not getting rid of it, they're just saying, we're getting rid of it on new agreements, okay?
Or modify it.
And if you modify it, that's a good point. If you modify it, you gotta expressly tell them in the agreement that you are gonna be subject to the new rules. If you can modify it and still not be subject to this elimination, okay? So that's one way the government deals with this stuff. They say if they don't want to deal with it, they'll say, we'll eliminate it. So that's one way, okay?
It's an easy way.
It's easy way, yeah. Miscellaneous itemized deductions. That's gonna hurt, well, it might hurt people who are W-2 people who have, computer, unreimbursed employee business expenses. That's gonna affect them. It's really gonna affect people who win court cases. Because if I'm, say that I get hurt or something like that, and I sue somebody, and I have a judgment, and I'm going to get $300,000, I have to pay my attorney $100,000. So in this example, that $300,000 I have to claim as income. That $100,000 in the past I would put that as a miscellaneous itemized deduction. I'm not getting that. I'm not getting it as a deduction. So now I'm paying tax straight up on $300,000. I may only benefit, in that example, I may only benefit by $65,000 after taxes. But the other part of it is, going back to this, miscellaneous itemized deductions was subject to alternative minimum tax. So once you were on alternative minimum tax, you weren't getting this anyway. So, the government giveth and taketh away. The Affordable Care Act individual mandate was repealed. I think there's talk about Maryland, that they may be mandating it. The other thing I just wanted to say about Maryland, is something we need to watch out for, is the states right now are going to be looking at a windfall in collecting taxes because they're raising the itemized deductions. More people are going to use the standard deduction. The standard deduction is not increasing at the state level. We're getting rid of the exemptions on the federal level. If you get rid of the exemptions on the federal level and you don't itemize, you can't itemize on the state return under current law. They're thinking about changing that. Maryland's thinking about either giving the money back or they're going to keep it. We don't know, and I'm not really sure, but this is something to look out for. We were talking about alternative minimum tax. They raised the exemptions, the amount, so fewer and fewer people will be hit with alternative minimum tax. Estate and gift tax. They kept this, but they increased it to 11. So essentially, it's 11.2 million now. And with that, I just want to caution people is they might think, well, I don't have to worry doing any estate planning. I don't need to worry about that anymore. And I would disagree. I think you need to look at it because in the past, the government was the biggest threat of taking away your legacy. What you're going to pass on to the next generation. They're not the threat anymore. So now it's third parties, and now you still have to do some planning and estate planning. So I just want to caution you, just don't think that we don't need to deal with it. We still need to deal with it. It's just that we have a different threat. There was also this piece limitation. This was essentially when your AGI hit a certain level, you lost itemized deductions. They took that out. Kitty tax, kind of exciting here. Very complicated. If you had young kids and they had taxable income, unearned taxable income, they were taxed at a certain amount. They were taxed at their parents' rates. Very convoluted. You had to put your parents' rates on the kids' return, or you put the kids' income on the parents' return. So very complicated. So what they did to simplify things, is they said, you know what, we're gonna change this. You're now gonna pay, the kids are now gonna pay essentially over $2,000 of unearned income. They're now gonna pay at the estate rate, state and trust rate.
What age is this for?
It goes all the way up to age 23, believe it or not. And I'll talk about that. That's a very good question. It goes all the way up to 23. So, the problem with that is the trust rates, the rate gets up to the highest rate at 37% with only $12,500 worth of income.
Wow.
So we've had some people who, you know, they did like the old days where, you know, the parents would set up these Uniform Gift of Minors Act, put the accounts in their kids' name, but they were really a custodian. Kids go to college and sell the securities. And we're thinking, oh my gosh, they are just going to pay a lot of taxes now. So that's what happens. And you can't get out of it. You can say, well, I'll just get out, I won't claim it. Doesn't work, doesn't do anything. The only way out of it is the kid has to, you know, the kid would have to either get married or have a child. So again, it's a planning involved.
Oh my gosh. That's convoluted.
The Roth conversion, this is kind of interesting. And it's kind of timely with the market going down. So the Roth conversions, there was a lot of talk that they were going to change a lot of things to IRAs, and this is the only thing they changed with IRAs is this Roth conversion. So what this means is I can do a Roth conversion. I can take an IRA, convert it to a Roth. Why would I want to do that? Because I want to have tax-free income for the rest of my life on that account. But what you could do, we call this the poor man's hedge. I could convert a part of the IRA into a Roth IRA. I could wait up to 21 months. If I did on January 1, I could wait 21 months and say, never mind, I want to undo it. Why would I say never mind? The market went down. If it goes down, I don't want to pay tax on something that went down in value. Now the government says, no more of that. No more poor man's hedge. You can still do a conversion, but you're not going to undo it. Okay? The 529s, you can now use that. You can take up to $10,000 for, used to be, you had to use that for college. Now you can use it for elementary and for secondary schools. Personal casualty and theft is suspended, it's no longer unless it's in a federal disaster area. These are all the other changes that we're not talking about today. One thing I do want to talk about, this thing here is, you know, they're talking about penalizing preparers if they don't use the head of household due diligence. You know, so this is another way. The reason I bring this up is because it's another way that they enforce things. Is they put pressure on the preparers by penalizing them. $500, you might say, well, that's nothing. That's no big deal. But if they start looking at it and go across the board with clientele, you've got a problem. There's some penalties that this is not a big deal. The big deal was some of the penalties that they were enforcing when you had a $100,000 penalty. If it was a listed transaction, and they don't like listed transactions, they want to find out about listed transactions, the penalty was $100,000 for not disclosing it. So that's another way that they deal with compliance, is they put pressure on the preparer. And if you the client are paying the preparer, but yet he's worried about the being penalized, it sort of changes the dynamics of the relationship. Yes.
Do you mind talking about the carried interest?
The carried interest.
That's on rental properties, right?
No.
Is that what we're talking about?
No, that's not.
That's not it.
It's very. It's usually it's usually dealing with businesses for the most part.
Did they do anything with if you make over a certain amount of money and you have losses on real estate, you can't claim it because you made over a certain amount? Did they touch that?
No.
It's still the same.
No, but they did. There's a.
They had to.
The one
have done
gift they
something.
messed with, so we'll get that. There is a thing about not sort of rental properties, but also your business, your Schedule C business. So we'll get to that. That's the last thing we're going to talk about. Very complicated, and I want to save some time for that.
Sure.
The first thing is the corporate tax rates were reduced. So now we are at 21% instead of a graduated or overall 35%. We're down from 35 to 21 businesses. This didn't come about in the last 2 years. this was discussed 10 years in the making, because we had an uncompetitive advantage, we were penalized when we competed globally with other countries because their tax rates were a lot lower, and we lost a lot of business. People left the United States and set up in lower tax rates. So this is what they came up with, a 21% flat rate. Ironically, this only affects, of all the business returns out there, you know, because you have the corporate returns, you have S corp returns, you have partnership returns, you have LLCs, and you have Schedule C, sole proprietor returns. This only affects 6% of returns filed. Not, you know, based on returns filed, not on the dollar volume and all that, but just you look at returns. This only affected 6%. That's why they came up with this pass-through deduction that we're going to talk about at the very end. It was to help out everybody else. Okay. The corporate alternative minimum tax was repealed. I really didn't come across that too often. This is kind of a big deal. Increased Section 179 expensing. You can now expense, when you buy an asset, you're supposed to capitalize it and depreciate it over its lifetime. They're now, but you can always 179. Now they increased the 179 up to $1 million. So you can expense up to $1 million of property. The downside of code section 179 is you cannot use it to generate a loss. The other part you have to be concerned about is if you use it for business, like say you use it for a vehicle, and you take depreciation 1 year, and then all of a sudden next year your business use goes below 50%, you're subject to recapture. Or if you sell the asset within a certain time period, you are subject to recapture. The nice thing about it is I can pick and choose what assets I want to expense and what assets I don't want to expense. Okay? Compare that to the 100% bonus depreciation. It used to be called 50% bonus depreciation. Now it's called 100% bonus depreciation. So you can write off 100% of the assets, just like you could have done on 179. The difference here is that it's by class. So if I have a class of vehicles, or I have tools, or I have computers, I have to use it on the whole class of assets. I can't pick and choose which assets I want to use. I have to use it for the whole thing. The other important thing that you have to remember is you have to elect out of it. So if you don't elect out of it, it's going to, you're in 100% depreciation. You're going to take it. You may not want that. Why wouldn't you want to do that? Well, maybe you're going to have higher income in future years, and you want to spread that deduction out over a number of years. You may not want to use 100% depreciation or bonus depreciation. You can also see after certain years it's going to go away. It's going to decrease. It's going to start at 100% and then go down to 20%. So 179, you know, except for the first 3 years, you might use this. 179 in the later years. The luxury automobile depreciation limits. This might affect you all. They increased those limits. You can kind of see by the chart here, you know, 10,000 versus 3,160. These numbers here are without the bonus depreciation. They didn't change the bonus depreciation. You can take up to $8,000 on the vehicle. So you can kind of see that you can expense this a lot quicker. I can, after 5 years, and if I take the bonus depreciation, I can depreciate up to $49,000. Under the current old laws of 2017, using the bonus depreciation, even using the bonus depreciation for $8,000 after 5 years, I was only at this number. And I calculated out how long it would take me to get from here to there, and it's roughly 15 years. So this is a good thing. And of course, this also assumes that you're using your car 100% for business. Okay, so if you're using it for 60% business, you got to take 60% of the numbers. Okay. Like kind, yes, sir.
Kevin, the thing with the vehicles doesn't have to do with the weight anymore. You remember the thing that they used to have where it was 6,000 pounds? If it weighed that amount, you couldn't write off a certain amount.
Oh, yes, yeah, that's still in play. In fact, they've gotten even more technical. with it. They even now measure the bed. Because some people, I guess, were buying those avalanches. You know, it's over 6,000, I guess they're over 6,000 pounds, I really don't know. But the beds are shorter. And you weren't able to get the full depreciation, like the write-off of 25,000, like you could, normally could, because the bed was short. I do have a chart that I can share with you that it shows you by asset, by weight, and the length of the bed. So it's still in play. Your question?
I didn't know you could use a like-kind exchange for anything but real property.
You and about 99% of other people are sitting in the same boat. So when did you use like-kind exchanges and may not have been aware of it? Well, that's real estate. So when would you have used a like-kind exchange and may not realize you were using it?
Trading your car.
Trading your car. Exactly.
Oh.
So when you trade your car in and you had a gain, you traded it in and you decreased the basis for that gain and move forward. Now you're not going to be able to do that. You can't do it with equipment. So you might have done it on a piece of machinery. You can do it on vehicles. No more. So this is where the real estate industry, you know, they kept that in there. The other part I failed to mention about, you know, referring to your industry, the lobbyists got involved in, you know, the mortgage interest deduction they may have lost. But the other thing they did gain is the idea of 2 out of the last 5 years. Remember, if you sell your house,
Right.
2 out of the last 5 years, and you could exclude up to $250,000 if you're married jointly. It's $500,000. They were going to change that. And in fact, it was in both. Yeah, they were going to change it to 5 out of 8.
Oh, man.
Oh, man.
They were going to change it to 5 out of 8, and it was in both bills. It was in the House version and it was in the Senate version. And something happened. I think, you know, we don't know.
I think the Senate.
But it's still 2 out of 5.
2 out of 5 will pull 3 out of 5.
But you can only do it every 5 years, right?
Actually, every 2 years.
You can, I thought that they changed it to, you could only do it in increments of 5 years.
Nope, it's 2 years.
Wow. I have to tell my husband that.
There you go. Yeah, the idea was people were going to move into rental properties and sell the properties and move into not sell the properties as their principal residence, not pay that. I don't think too many people were doing that, but that was, we told people that they could do that, and they said, no, I'm not going to do that. Too much work. So the like-kind exchanges are still available except for property other than real estate. Oh, this one hurts. Oh my goodness.
Wow, that's amazing.
That, yeah. So, your Redskins tickets, your national tickets, you're writing that off. No.
This is for all
Meals?
Meals is a different story. Great question. Meals is different.
Glad I got rid of
That's
my
still available.
tickets.
So, you know, there's going to be some clarification on this. Someone's going to have to help us with this, because what if you buy a client a hot dog at the ball game? Not that, you know, I mean, kind of. I mean, so there's going to have to be some clarification on that. And now we're back to the big thing here. This is the new 20% deduction for pass-through income. Okay? So this is eligible for LLCs, and whether it's LLCs, an S Corp, a partnership, or a sole proprietorship. Everybody's entitled to this. And it even includes your real estate investors. So the real estate investors might be inclined to maybe, you know what, maybe I'll pay off that mortgage. I'll generate income, I'll have taxable income, but maybe I can use this 20% deduction. Now I'm incentivized to maybe paying off a mortgage on a rental property. How this works is it is below the AGI. So what I think is going to happen is they're going to take this deduction and they're going to put it where the exemptions used to be. The exemptions were on the second page, right after itemized deductions. You had personal exemptions or standard deductions, and I think they're going to take that line out for exemptions and put this in. So it won't affect AGI. And AGI has nothing to do with this calculation. It's all taxable income driven. But it gets very, very, very complicated. It doesn't affect FICA taxes. And this is going to affect a lot of people. Every Schedule C, every Schedule E has potential in this. And yet, it is going to be very, very complicated when you get to certain income levels.
What is it? What's past the limit?
Pass-through income is anything that hits any business where the income hits your tax return. So it's your Schedule C, it's your rental income, if you have rental income, if you have income from real properties. If you have a partnership, that's pass-through. If you have an S-corp, that's pass-through. The thing it doesn't affect is if you have a C corporation, that does not pass through. That's a separate taxing entity. The tax is paid at that level. It is not passed through. So that's what they mean by pass through. It passes through from the business entity and hits your return. Is that helpful? Is that okay? All right, so what happens, what do you do? I mean, so you say you have your Schedule C business, you're a realtor, you have a real property. What are you going to do? So you've got to net all these activities together. And if you have income, you might be eligible for the 20% deduction. It is limited to 20%. You take the lower of 20% of the pass-through income, which is your Schedule C, Schedule E, or the 20% of your taxable income. I'll give you an example. So let's say I've got a corporation and my pass-through income is $100,000. So I'm thinking $100,000, I'm only going to pay taxes on 80% of that. I get a $20,000 deduction. Yay. But maybe my itemized deductions are so high that I decrease that. So I'm not, maybe my taxable income now, instead of being $100,000, it is now $80,000. So I have to take the lower of the two. So the lower of the two, I got to take 20% of $80,000, which is now $16,000. Okay.
Is this going to affect rental losses?
Yes, it kind of does. How it affects it is if I have a loss in a given year, I got to carry that loss to the next year.
What happened with my husband and I is that we have a property that we were losing money on until we get it sold. And last year we got hit hard with taxes because of the income, the combined income was a certain threshold.
Yep.
And we couldn't claim but a small portion of the loss.
That's correct. So if it doesn't hit taxable income, you're not going to get a deduction for it. Okay?
Right.
So if you have a loss, it doesn't get a deduction for it. If you have a loss or you're zero. So
But in the future, if you make less money, can we then just, we're not asking for a 20% deduction. We just want to get our losses off the book.
So the suspended losses, you would get your suspended losses back to you.
Okay.
Okay? And once they're used up, you might have income, and then the income starts hitting the return, you'd be eligible for the 20% deduction. Okay? So we talked about it carries over to next year. But ironically, let's say you had losses 2 years in a row. Say maybe for 18 I had a loss, 19 I had a loss, 20 I have income. I only take the loss from the previous year. I don't take the loss from 2018. Okay? So it's not cumulative. If it's a net operating loss, it accumulates. I'm able to take that in the future. I only have to take this from the subsequent year, from the previous year, the one previous
So you
year.
have to claim previous before you can do the current.
Well, I have to deduct it. So if I have a loss, which helped me on my taxes the previous year, the next year say I have a $4,000 loss in 2018. 2019, I've got a gain of $10,000. So now I take the $10,000 minus last year's $4,000, I get $6,000. 6,000 times 20, I get $120, $1,200 deduction. Okay. I know it is it's kind of complicated. Anything else I want to cover on that? I think that's good. This is where the drinking is going to start, I think. So the issue here now is what happens when my income reaches a certain level. If I'm married filing jointly, and let's just take the high extremes. If I am married filing jointly and I pay over $400, my taxable income is $415,000. I got to do another calculation. Not only do I take 20% of the, well, let me go back to this. this is pretty simple. Hopefully everybody will be in this situation. This will probably deal with 90% of people. You know, you look at two things. You look at your taxable income and you look at your pass-through income. You take the lower of the two, times 20%, you're good, okay? So I think that will take care of most people. Where it gets complicated is when the income levels increase. Now I gotta start considering my depreciable property. I gotta take the lower of my qualified business income, 20% of the business income, or I gotta take the greater of my 50% of the wages that I paid, or 25% of the wages paid plus 2.5% of my depreciable property. That's where I think that, you know, it is kind of messy.
That's where you come in.
Well, yeah, right. But there's also is, you know, if you're in that situation, you gotta start planning now. Because if I don't have wages paid to other people, I may not get the deduction. So now's a great time to start dealing with it. Maybe I want to get my kids on the payroll.
Is that why they're giving all those bonuses?
No, it has nothing to do with that. Well, they're doing the bonuses because of 21% thing. So there's a lot of planning opportunities, but you got to start planning now. You might want to, you know, they talked about possibly instead of having your, if you have independent contractors, start making them employees. If you lease equipment, you might want to start buying it so that you have depreciable property. But again, this is not something you're going to pull out at December 31st and say, oh yeah, I've got this. It's not like a funding your IRA or funding your retirement plan. This is something that's going to require some planning if you're caught in this. And it gets even worse. So, you know, the thing I talked about is pretty hairy. But it gets even worse. If you're in a, if you're in a personal service business, and they're listed out here, if you're over $415,000, you get no deduction. And then if you are between the 315 and 415 and the 157 and the 2075, it's a phase out thing. So these are all the professions that are considered personal service. And really, the only ones that were exempt from this are the architects and the engineers. So I'm not sure how much their lobbyists were paid. They were paid pretty well. Except they might come back. This may get them. The part where you know their reputation. People come to them for a reputation that may come into play, and then they're forced back into this thing.
It's vague. It's very vague.
Yeah. And it is vague because what if I'm a blogger, and the people come to me because it's me, but then all of a sudden I get so much traction that I can sell this thing off. There is a lot of.
So how do they figure your taxable income if you don't have deductions, or then how do you get to the 415 with your deductions or before the deductions?
Great question. It's before your deduction. It is after your deduction. So you take your business deductions, you get to the bottom line. What was my net profit from this business? And if you have several activities, you net those together. Okay. But it's after deductions, after FICA taxes. It's not going to lower your FICA taxes. It's still there. We talked about the industries that are affected by this. These are the other changes that are happening to businesses. Business interest, domestic production's gone. That was the old. So this new 20% deduction is called Code Section 199A. Domestic production was the old 199. And the old 199, the architects and engineers had preferential treatment. And for some reason, they maintained that. These are the things that we didn't kind of talk about that affects businesses. It's not that important until it affects you, then it's important. So if you have any questions on anything, let me know. And again, I want to thank you all for coming. This is it's exciting times in that it's an opportunity for you all to, again, help out yourself, with the new laws, and also be a resource to your clients.
I'm not sure if you covered this, but what about like the debt, the mortgage lender cancels due to a short sale? I remember like every year it changed. Like if someone has a short sale and they owe, you know, it was say $80,000 short or $50,000 short, do they have to pay taxes on that short?
Possibly.
Yeah, debt forgiveness.
Possibly.
Yeah.
There's ways out of it.
It like changed every year. Do you know what it is for this year?
Well, they got rid of the home, where it was your home residence. I think they got rid of that. But what you can do is, if a person can prove that they're insolvent, they can get include that as income. And what you do is you take your assets as of a certain date, your liabilities of a certain date, compare them. If the liabilities are higher, then you're insolvent, technically insolvent, and you don't have to recognize it. If you claim bankruptcy, you don't have to take it as income.
But if you don't, I'm sorry. What
No,
were you
go
gonna
ahead.
say? No, were you gonna talk about that? Okay. Yeah, no, I wasn't sure if I tell clients that it's forgiven or not forgiven. So.
I would
Don't
never tell them
anything.
anything.
I
Don't
just,
tell
I'm
them
doing one
anything.
right now,
Yeah.
and sometimes it will come back with the instructions for closing. We're doing one, there's a large loss, but the bank has said, the investor's HUD, the balance, and it has an amount, will be forgiven. You don't owe it. So then, you know, they don't owe it. They have something, and they'll receive something that says that it's a wash.
I mean, I always say consult a tax attorney, but
That's the best
I
advice.
Yeah,
still would
that's
like
all
to
you
know.
should
Don't
say.
tell them so they can plan.
And the other part of that is you don't know when the 1099 is going to come out. It's when they write it off. It's
That's
when
right.
you don't know when it's
Law
going
can
to happen.
change.
The law can change. It could be 2 years from now, and they can decide we're writing this off at this point. We're done collecting it, so it may not happen right away. I think they have up to 3 years. I'm not sure about that, but we've dealt with it 2 years after the fact.
Okay, thank you.
So is it age 70 and a half where you have to cash in your Roths and all those kind of accounts?
Oh, that's a great question. So the Roth IRAs, do you have to cash them all in? No. One, the Roths are not subject to RMDs, so they stay in perpetual. One of the things the IRS, the Congress is thinking about changing is they were thinking about changing the stretch IRA. The stretch IRA is when, if I pass away, my wife passes away, we give kids our IRAs to our kids. Right now, I could have it set up to where they can take that money out over their own lifetime. Pretty cool thing. Congress didn't like that. The IRS didn't like it. Congress didn't like it. We all thought it was going to change. They voted 26-0. They thought it ought to change. It didn't come through. It didn't make it. So to answer your first part, Roths are not subject to the 70 and a half. What is subject to is your IRAs, your 401ks, your 403bs. And they don't force you to take the money out. All they do is say, you're going to take a portion of this out every year, based upon the prior year's balance as of 12/31. And so, for instance, the first year, I just know at 70 and a half, it's roughly 3.5% that you have to take out. So you're going to take out 3.5%. It never wipes it out because it's always on a percentage basis. It does wipe it out if you are dealing with inherited IRAs. It will get to zero on an inherited IRA.
Which kind of IRAs?
Inherited IRA.
Inherited.
Any other questions? Again, thank you.
Good job.